Good evening, everyone. Welcome to our University of Florida Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Thank you so much for taking time out of your schedules this week. I know we're almost wrapping up the week, but I really appreciate you spending some time with us to learn a little bit more about homeownership. So I know we're kind of filing into the Zoom session right now. Just want to make sure that we're all set and get everybody rolling for class. We are recording tonight's class. So you'll have a link or we'll be sending out the YouTube channel link for you tomorrow. You can look back to tonight's class. We'll also send all of our slides to you too. So everything we go through tonight, we'll get that out to you as well. This is a very interactive class, so we encourage you to ask questions of us, whether that's within Q&A or you can use the chat feature, whatever's good for you. We'll make sure that we'll be monitoring both of those windows and take on those questions. I'll also carve out some time for some Q&A later on in tonight's class. Our run time takes us up just about to the top of the hour. So we'll get to the top of the hour, but make sure we kind of fill in everything. This is a class that we put on 4 times a year. So every quarter we present this class to the alumni community, really looked upon as really a great tool and resource for you in the homeownership journey. We've had several of your fellow alum that have got a chance to use us in the process, and we've tried to create that really seamless experience for them. I'll be your presenter this evening, but I'm also someone that works with you when we kind of build your financing options for you. And I work for an organization called American Pacific Mortgage. We're the 9th largest lender in the country. Our team in particular focuses on kind of grassroots efforts with homebuyer education in our local communities to support you on this journey towards homeownership. So we really start with classes like this. And this is kind of our launch pad into homeownership and really taking that step to going out and looking at a home, or first of all, figuring out what I qualify for, then looking at a home, and hopefully down the end of the line, getting the keys to our house. So there's kind of a process that we take you through that. We are going to talk about that process in tonight's class as part of our 6 steps of home buying. But we got some other great talking points that we'll go through. And I hope that you'll be able to take away a couple key things for you on your own journey towards homeownership. We'll spend some time talking a little bit about the housing market, what's happening with it right now. Also look at what's going on with interest rates. We had a nice little movement in interest rates just to close the business day today on Wall Street. So that's an encouraging sign. Unfortunately, if you're looking at your 401ks, not so good because the Dow took a 600 point drop today. So not super great, but good for interest rates. We'll talk a little bit about renting versus buying, like looking at a budget of renting versus what it could look like on the buy side. Spend some time looking at credit, how we can give you maybe some better understanding of credit and what makes up your credit score, and maybe some tips or tricks really to help you around credit. We will also talk from a high level look at loan programs. What are some of the guidelines that I should be aware of when it comes to loan programs? Savings for homeownership, saving up for down payment as well as closing costs. What are some of the resources I have that I can use towards that? But also, what's a plan that I can help get myself on track for savings? And first-time homebuyer programs can also close that gap for us between what we need for down payment and closing costs versus what cash I have on hand. So I'll spend some time talking a little bit about some of those first-time buyer programs available all across the country. They are state-specific, so we will definitely make sure that we talk a little bit about that in tonight's class. And then really, the buying process. I kind of alluded to this earlier. We start off in the classroom setting like this, a learning environment. And then from there, we go into the buying process, our consultation, getting pre-approved, finding the right home. We're going to walk you through the 6 steps of home buying and what it looks like to take on that journey of home ownership, and explain to you a little bit more about our consultative process. Okay. So that's our plan for this evening. Hope you enjoyed tonight's content. And as we kind of explore some like the first time buyer program options, it would be great to learn a little bit more from our class, like where do you think you want to purchase? So if you have a second, just drop in the chat where your intention is to purchase. Because when we get to our first time buyer segment, I like to be able to apply some of the resources that are out there for you. So you can just drop your intended location in the chat, and we'll make sure we take note of that. Because whether you're going to buy in Gainesville or you're going to buy in Austin, Texas, or Atlanta, Georgia, those first-time buyer programs can look a little bit different. So we want to kind of explain to you some of the opportunities that are out there. All right. So let's go ahead and dive in. Let's talk a little bit about buying. Does it make sense for me? Hey, it's going to be probably the largest purchase you decide to make at some point in time. When we think about our current path of renting, we're obviously, paying someone else's mortgage, probably the landlord that has a mortgage on the property. And that landlord's probably going to you at least once a year and saying, hey, guess what, Jason, we're going to increase your rent by $100 or $200, right? Now, as a homeowner, you have more kind of a control in your outgoing expenses for housing. So that is one of the big benefits of homeownership. I have stability now in my housing payment. Many of our buyers that are buying in today's market are probably going to consider refinancing at some point in time. Now, we're still at elevated interest rate levels right now, but at some point in time, we're going to be able to look at refinancing down the road. And so, if I bought my home today at 6% rates, well, maybe rates drop to 5% at some point in time. Once we see at least a full 1% reduction in interest rate, then we would want to encourage our clients to consider refinancing to help improve their overall payment situation. And then this is an asset that should go up in value over time. So if I purchase my home at $400,000 and I put down 5% on my mortgage down payment, as that home goes up in value, I've created that initial 5% equity position. But as I pay down my balance, as my home goes up in value, the difference in the market value versus what my balance is now, that's called home equity. For most of us, that is our number one asset that we have outside of maybe some retirement resources. For most of our clients that I work with on a daily basis, that does have opportunities to create generational wealth for families all across the country. So it's really a huge opportunity. And a lot of people don't think about this, but there's tax benefits that come along with owning a home, potential tax deductibility with mortgage interest, as well as tax benefits if I decide to make some energy efficient improvements into my home. Okay, so a lot of great things that can come out of that when we think about home ownership. Now, as we budget for home ownership and consider what we think we can pay on a monthly basis, we also want to do a quick comparison of what does the path look like for me on renting versus what it looks like on the buying side. So I wanted to bring to you guys one of our tools that we have available on our website. We have a lot of great tools that are available to you, but I think the rent versus buying calculator really can paint a picture for you as a potential homeowner of what it looks like to compare, like I said, continuing down that path of renting versus what it could look like on owning side. Really quick, I want to just take a quick pause for a second. I want to make sure from a technology perspective, we're good. Can you guys see me okay on video? I want to make sure the video is all good. Are we good on that outside of it? We're good. Okay, I got the thumbs up. All right, good. All right. Our video, I kind of had a different look over here on my side, so I want to make sure you guys can see me okay. So anyways, okay, let's talk a little bit about the rent versus buying calculator, but I do want to kind of bring your attention to, these are some of the other calculators that I mentioned, whether it's affordability, just basic payment calculators, or considering to refinance. Now, let's turn our attention to this rent versus buying calculator. For our timing of tonight's class, I would just pre-filled this in for you guys to illustrate the point. But let's say you're looking at buying a place in a single family residence in Gainesville, Florida, right? For $450,000. The minimum down payment is 3% of the purchase price, which means I would finance 97% of that purchase price, or $436,500. We kind of plugged in today's interest rates. We make the assumption that it's going to be a 30-year fixed mortgage. And that, let's say we buy our home in March, right? Just to kind of a placeholder there. Now, we're going to talk more about mortgage insurance later on tonight in our PMI section of tonight's class. But when I put less than 20% down to buy a house, there is PMI. And so we factor that into our payment calculation. We have things like homeowners insurance costs. For those of us that are going to purchase in some of our higher cost of insurance markets like Florida, we'll bake that into our budget. We have taxes for that respective home. If I'm going to buy a condo or a townhouse, there's probably HOA dues. And then one of the big benefits, like I mentioned to you, there's tax benefits of potential tax deductibility of interest. So let's put in our tax bracket. We put maintenance costs to my home. Now, eventually, I'm probably going to upgrade my home, and this is going to be kind of the launch pad into my second home. So we want to factor in the future selling costs of my home, the appreciation rates, and then we compare that to maybe what my current rent situation is. So if we say that, let's say I'm paying $2,000 in rent with renter's insurance, as well as assuming that my rent will go up about 2% every year. Okay, so that's our comparison right there. $2,000 in rent versus buying a $450,000 home. So if we look at our break-even point, and we're kind of turning our attention to this graph here. So my break-even point right now is 4 years. So that means the investments that I make into home ownership versus what I'm going to pay out in rent and have my rent go up 2% every year, My break-even point is about 4 years. That means I will now be profitable of homeownership after 4 years. And we at least would want you to be profitable in 4 years. And of course, if you're paying $3,000 in rent and you're buying a $450,000 home, those numbers are going to be so much more favorable. But that kind of illustrates our point of the break even. More importantly, and this is where really kind of the magic of homeownership happens, is that as I span over time, let's say 7 years, if I continue to rent at $2,000 a month in rent versus that $450 in home price, I'm going to have a gain opportunity of set after 7 years of $46,000. Now, I would say you probably could argue that someone buying a $450,000 home is probably spending a little bit more in rent. So this, if you were spending, let's say, $2,500, you can see how that gain opportunity almost doubles, right? So it's all going to be relative to what you're paying in rent right now, and then what you're jumping into from a housing perspective in terms of the purchase price. But you can see here, if I have a higher rent, now my equity position goes up. Now I got $161,000 in equity in my home after 7 years. As I push that further and further out, 10 years, then my appreciation is increased because it's going up 3% on an annual basis. So that is really where homeownership is the difference maker. Really, we think about equity appreciation, we think about tax benefits, all those things make up that asset growth for you, or wealth growth, I should say. So I would encourage you, take a look at that calculator when you have some free time. I think it's a great way of really kind of helping paint the picture of homeownership. Because so often when I meet with clients, they say, Jason, you know what? I'm paying $2,000 a month in rent, so I got to get that mortgage payment around $2,000, and maybe that doesn't give them the buying power they really want. But when we factor in the elements of tax deductibility, equity appreciation, it starts painting the picture of maybe I can afford $2,500, maybe I can afford $3,000 a month, and that can create a better opportunity for ourselves as future home buyers. Now, when we jump into the market, what's going on with the housing market can play into that timeline, right? And I wanted to give you a snapshot of what's happening in the Florida housing market. Now, Florida is one of 4 states right now that have plenty of supply. There's lots of inventory out there. It is a buyer's market in the Florida market right now. So we're seeing homes, you can see on 82 days, median days on market right now. So that's one of the highest in the state right now. What's driving that? Well, insurance costs are really playing a big role in what's happening in the housing market. It's really expensive to insure in Florida, very similar to what we see in California. Now, it's not, preventing people from buying, but it certainly is a driving factor for buyers, especially when you add in the element of where interest rates are at today. So, I think when we're considering jumping into the housing market right now in Florida specifically, there's some really big opportunities out there. And we've helped several clients in 2025 buy in the Florida market at really reasonable prices. Because here's the other thing that you find in buyers markets is you have sellers that are not only more flexible on sales price, but they're more flexible in what they're going to contribute towards closing costs. Seller credits is what we would call it. And so there is some opportunities. Now, Florida is one of the other 3 markets that are similar to Florida is Colorado, Texas, and Georgia. They also have some extra supply there. And so, that does make it more appealing. As we look kind of further out in the housing market, what does our forecast look like for this year in terms of the entire country? Well, I think this year is going to be a little bit of a reset is what we're kind of thinking. We've been through a really tough last 2 or 3 years with interest rates, and it's made it a little bit more challenging from an affordability perspective. So I think things are going to become a little bit more affordable for mortgages as rates start to ease a little bit. Price growth isn't going to be outrageous. I think it's going to be kind of modest. We may see some areas kind of slide back a little bit, meaning prices start to drop a little bit. We have some markets that are a little bit overcooked. I would say some of our markets in the Bay Area in California, we're seeing some of those prices start to slip a little bit. Somebody's doesn't really want to run out and buy an $800,000 or $900,000 condo or townhouse, right? So I think you're starting to see a little bit of price change there. Inventory might improve a little bit in some of the local markets. Builders are also trying to build more homes to help support that. But I do think you're going to see more buyers active on the streets this year. And really, we're witnessing it firsthand with our own clients that we're working with all across the country. We are probably up about 50 to 60% in buyer activity year over year. It's interesting, and as I've been a part of the business for several years, once we get past Super Bowl weekend, believe it or not, that's when you see a lot of buyers start to become a little bit more active in the market. So we are certainly seeing it after Sunday's Super Bowl. We're seeing more buyers starting to re-engage and evaluate their options. Now, as we compare 2025 to 2026, Interest rates are going to drop a little bit. We've already seen that happen in 2026. So a little bit of improvement there that will drive things. I think this is saying in Q4 we'll probably be at 6.1. I think realistically we're probably going to be at 5.7 by the end of the year. You're going to see existing homes come up by about 9%, which is a really good sign. Median home prices are not really going to increase nationwide, maybe by 0.9%. And then the inventory is going to come up a little bit. Now we're seeing, like we just talked about in Florida, we're seeing more inventory. That days of market is really kind of start to grow here. But inventory has really been a challenge in many parts of the country. And like I said, builders have been trying to make up the gap, but they just can't do it. Here's a look at interest rates. Interest rates is a hot topic, obviously, for buyers. That is going to drive a lot of your buying behaviors in your market. So interest rates are going the right direction. Finally, you can see as we span over the last 2-3 years, interest rates have been at elevated levels. In fact, 2 years ago we saw interest rates hit almost 8%. So that was definitely not ideal from an affordability perspective. But I do think the 30-year fixed mortgage is going the right way. As you're paying close attention to what's happening in the economy, the Federal Reserve is monitoring what's happening to two kind of key economic indicators. They're looking at what's happening with inflation. So are we getting lower reads on inflation? The goal or mandate for the Federal Reserve is to hit 2% inflation. And they're also looking at what's happening in the labor market. So, are we having new job creation? What's the unemployment rate look like? All those important things. There was a report that came out earlier this week, and one of the inflation indicators showed a little softer inflation. So in turn, we had a nice little improvement in interest rates. Today, as I mentioned, as we kind of launched into class, the Dow Jones dropped, I think, 600 points today, which the Dow Jones, or what the stock market's doing, has generally an inverse relationship to interest rates. So stock market goes down, interest rates are probably going to have a better day, which is essentially what that means. Now, the 10-year treasury is something you can monitor when you're looking at interest rates yourself. Today, the 10-year treasury closed at 4.1. Just a week ago, I think it was as high as like 4.28, maybe 4.3. So, we are going the right way from an interest rate perspective. And, as that continues to get traction with interest rates, that will start to fuel more buyer activity. Now, interest rates are not the same for all buyers because there's things like credit score and eligibility that makes up what your interest rate looks like, what your down payment is, how much you finance, what program you're going to select. Some clients will choose to buy down points on their loan, which is essentially paying more expenses out of pocket in order to bring down your interest rate. So let's say I wanted to pay 1 point, which is 1% of my loan amount, and I'm financing $300,000. That means I'm paying $3,000 in order to drop my rate by, say, 0.25%. It doesn't make a lot of sense to do that unless you really have to, because the break-even point is about 3 to 4 years for those investments. Term of my loan can also impact my interest rate. So whether I do a 30-year loan or a 15-year loan, that can change my interest rate. Now, most clients don't understand that interest rates change based upon the trading day in the financial market. So, the stock market opens, the trading day closes at 2:00. Interest rates move every minute during the trading hours. So interest rates could start at 6% at the opening of trading. They could be 6.25% by the end of the day. They could be at 5.8 by the midday mark. So interest rates change. Now, when you go under contract with a seller, now we're kind of on the clock to strategically watch the markets to try to time for the best interest rate in the market. That's one of the things we do as a partner with you on this home buying journey, because obviously affordability is paramount for our clients, and we want to make sure that we lock in the lowest rate option for them. All right. Now, one of the things that goes into interest rates is credit, right? Credit plays a big role in your product selection, the cost or expenses with your financing, and like I said, that interest rate. Every loan program has a minimum credit score, and so we put those up on screen for you. And when we look at credit, we're going to take a closer look at the mortgage score, because there are 3 different scoring methods to credit scores. There's the credit card model, there's auto financing, and of course, the mortgage model for your housing purchase. Now, if you've had challenges on your credit, maybe a late payment, especially in the most recent 12 to 24 months, that's going to drive that score down probably in those most recent 12 to 24 months. But as I get further away from the date of my last payment, then I should start to see organic improvement in my credit score. Every credit agency delivers a different score to us because they have different risk models. So like earlier, just a couple hours ago, as I was working with a client, that client has TransUnion at 710, but their experience score is 716, right? Because those two agencies have different risk assessments that they're looking at. Now, in lending, we always take the middle credit score of all three bureaus. So if my top score is 760, my middle score is 740, and then my lowest score is 720, we're going to take the 740 credit score when it comes to qualifying. Now, if I'm going to apply with my partner's middle score is 720, so I'm 740, but they're 720, we will have to take that lowest middle credit score between the two of us, which would be 720 for qualifying purposes. That's important because that can drive down the interest, drive up the interest rate with a lower credit score. It can increase the mortgage insurance, maybe even change the product that I'm looking at. And so, I get oftentimes when I'm working with clients, they'll say, Jason, hey, I know my credit score is 660, but what if I get a cosigner that cosigner help improve my interest rate? Unfortunately, no, because that cosigner, even though they might have a credit score that's a little bit higher than yours, the credit score that we use is going to be the lowest score between both borrowers that will impact that interest rate and product selection. Okay. All right. Now, when we think about negative items on a credit report, the impact is in the most recent 12 to 24 months. But how long is that image or transcript going to be on part of my report? Well, it's shown on this matrix here. So whether that's a hard inquiry that's going to last for 2 years or less, or maybe I had a major event, like I had a bankruptcy, and that will stay on your credit report for 10 years. But in the most recent 12 to 24 months, that's where you're going to see the impact to your credit score. Okay. Now, this is the mortgage model for credit. So I want to walk us through these different areas of the mortgage model and just kind of help you understand what those areas look like. And then maybe that'll trigger for you one of the areas of opportunity to help lift your credit score. Now, in our consultation process, I work one-on-one with our clients. So, we're going to talk through like your credit profile and say, okay, hey, what if we pay down that Chase card a little bit? Maybe that gives me a little bit of a lift in my credit score, or maybe I challenge that misreporting. Maybe that can improve my score. So those are one of the things that we do in supporting our clients in their home buyer journey. First component to the credit score for mortgage is length of credit. So we're looking at how long have I had credit. The more mature my credit file is, probably the better my credit score is. How much new credit am I trying to get access to? So am I opening a lot of new accounts, especially in the most recent 6 to 12 months? Am I having a lender, whether that's an auto lender, a credit card company, a mortgage lender, do hard inquiries on my credit? If I do that, that is going to have a negative impact to my score, especially in the first 6 to 12 months from those inquiries. Now, there is a rule in place that it has a 30-day window of time for me to apply with as many auto lenders or mortgage lenders as I want, but it has to be in a 30-day window. Now, our approach to that is a little bit different. We actually only start with a soft credit check when it comes to reviewing your options for you for home ownership. I choose to do a soft inquiry because it doesn't impact your credit score. Many times the buyers that I'm working with, especially in our classroom setting like this, we're building a plan to home ownership. It's not something where you're coming out of class and you're saying, hey, I'm gonna go buy a house this weekend, right? It's probably something that you're building a plan for 1, 2, maybe 3 years out. So I think it's really important to put a plan together for you, but not impact your credit score, or give you some coaching on credit, but not impact your credit score. Soft credit check allows us to do that. Next kind of section is amount owed around credit utilization, revolving credit, right? So simply put, we're looking at our revolving balances versus our revolving limits. If I have $8,000 in balances, my limits are $10,000, I'm running pretty high on utilization, so I'm like 80% utilization. I would encourage our client, let's now work to get to 50% utilization, which would be $5,000, and then work towards $3,000 or 30%, and then optimal is going to be 10% or $1,000 or less. Okay. Now, here's your tip for managing credit card debt and to try to get ahead of your credit score. So every month at the end of the billing cycle date, if you look on your credit card statement, there's a statement date or billing cycle date. If you can try to pay down your credit card accounts before that statement date closes, which is your previous 30-day activity, what you're going to do when you pay those accounts down or off, you're going to get ahead of the reporting. So if I bring my balances down to $3,000 and now I'm at 30% utilization before the statement date closes, now I'm going to have better utilization of credit, in turn have a higher credit score. And that's something I would encourage our clients to do, especially as you're getting ready to make maybe a major credit purchase. Now, when we meet with you for a consultation, we'll give you some, modeling on your credit score to see what things you should pay down. But that's a great way to help kind of lift your score with an easy approach. And then finally, payment history really is how much do I have in maybe delinquent credit cards delinquent accounts. Are they impacting my payment history? If I have on-time payment history, then that 35% is going to look great for us in our credit score. But if I had late payments, they're going to be rated as 30-day lates. 60-day lates, and then 90+ day delinquencies. Again, the activity that I see on my credit profile in the most recent 12 to 24 months is going to be the most impacting to my credit score. As I get further away from any type of like element that's like a negative item, the further I get away from that event, the better I'm going to have an improvement for my credit score. Now, one of the other things that we look at as part of the credit score or credit report in general is student loans, right? Some of you in tonight's class might have student loans. You might be in active repayment. You might be in forbearance or deferment, payment deferment because you're back in school. You haven't triggered the repayment. If you're in a savings plan right now for student loans, you're on an IBR, income-based repayment. If you're paying, let's say, $250 per month on $75,000 in student loan debt, that's the payment that we can qualify you with right away, right? Now, where it gets a little tricky is that if you're in forbearance or just not making payments at all right now because you're on pause with your student loans, then by product, we have to assess a minimum payment for you for qualifying. So if you have that same $75,000 in student loan debt and you're doing an FHA loan, then we would take 0.5% of those balances and assess a monthly payment. If you're doing a conventional loan, it'd be 1% of the balances as your monthly payment. Okay, so as we work through your qualifying in your overall home buying plan, we'll talk a little bit about student loans. But I think in working with clients on this element of student loans, it's really about, are you in active repayment or not? Many times clients think that if they have student loans, they can't qualify for a mortgage in general, which is really not the case. It just really comes down to, are we in repayment or are we not? And what kind of like payment amount are we applying for qualifying purposes? Because what we do look at in eligibility for home financing is your expenses versus your income. And we're going to talk more about that tonight, which is called debt to income ratio. Now, the reason why student loans come into the picture and how we have to evaluate those is because every loan program has guidelines that address student loans. So we have to make sure that we can meet those guidelines for their client and their financing. So in this segment of our class, I want to walk you through from a high level perspective, like what are some of the programs that you have at your disposal. The first one is the conventional loan. That's a Fannie Mae and Freddie Mac loan, minimum down payment of 3%. Fannie Mae no longer has minimum credit scores, but they have an overall risk assessment. And there's a maximum loan amount called the conforming loan limit. This one actually is a bit dated. It's the conforming loan limit for 2026 is like $832,000. So we can lend all the way up to that amount with a minimum down payment of 3%. Now, if you're in a high cost of living market, which for those of you that responded in the chat, I don't think any of us are in a high cost of living market. But if you were, like, let's say you're going to buy in Arlington, Virginia, right? We can lend up to basically about $1.2 million, but that minimum down payment jumps from 3% to 5%. Fannie Mae and Freddie Mac, you're seeing them a lot more in the news right now. They're currently kind of in a conservatorship of the U.S. government, but they're talking about disbanding Fannie Mae and Freddie Mac and privatizing, and there's some kind of like debate back and forth on that and what that could do to the housing market. But ultimately, Fannie Mae and Freddie Mac would be an option for a conventional loan. Other product would be FHA. FHA is a government insured loan, minimum down payment of 3.5%, a little bit more flexibility and lower credit scores. The maximum loan amount will vary by the county that you're going to buy in. Now, this is a government insured product, and about 4 or 5 months ago, they did make some changes with residency status, unfortunately, with this product, as well as the USDA product noted just below that. It does require you to be a permanent resident to participate in these programs. So unfortunately, that change was made. But if you are a non-permanent resident, you can still get access to a Fannie Mae and Freddie Mac product. Unfortunately, just not a government insured product. USDA is a product designed to support buyers that want to buy in more rural areas. It's a zero down payment option, has a lower credit score requirement. And then the maximum loan amount will vary based upon where the property is located, as well as the maximum income by household. The jumbo loan product is really going to be probably our second or third time purchase, but it's really going to be for clients that need a little bit more bandwidth or buying power with their financing. But it does come with it higher down payment requirements, higher credit score requirements. Okay. Last one I wanted to spotlight is the VA home loan. That is for our veterans that have eligibility under the VA home loan. It is a zero down payment option, minimum credit score of 620, just a lot more flexible guidelines to encourage home ownership for the veteran. And whether that's expenses versus income, or of course the lower down payment options. So VA is a great product to provide to our veterans to support them in the home buying journey. All right, so that's a quick look at different guidelines for programs. I want to spend some time talking about mortgage insurance because I get a lot of questions around this, like how much does it cost? What does it do? What's the purpose of it? Well, mortgage insurance has two different kind of lanes. There's conventional or private mortgage insurance, and then there's MIP, which is FHA government insurance. And we're going to give you kind of the characteristics of both. But ultimately, what mortgage insurance does is it insures the lender against default by the buyer. So if I had a hard economic hardship, the lender would be protected against my default on my loan because they have mortgage insurance. Now, on a conventional loan, it is required when I put less than 20% down. It is called PMI because it's private mortgage insurance. There's about 7 or 8 different private mortgage insurance companies that partner with APM. And they basically have a risk assessment that says, okay, based upon your down payment, credit score, and loan amount, this is what the premium is going to be. And so that gets applied to your overall monthly payment. Cancellation of PMI can happen on a conventional loan once I reach 2 years in the home and I have 20 to 22% equity. All right. And then if I look at a payment example, with mortgage insurance on a conventional loan, may not be as expensive as you've seen in some of your product searches online. Because if I say finance $450,000 and I put 3% down, I'm probably looking at about $138 a month. So that's based upon the down payment, credit score, and the amount financed. Higher I can lift that down payment, the more I can raise my credit score, the cheaper my mortgage insurance costs are going to be. Now on the FHA side, it's a little bit different because it's really kind of a one size fits all. So whether I put 3.5% down, which is the minimum down payment for FHA, or I put 10% down, or I should say 5%, the factor is 0.55% of my loan amount. There's also upfront mortgage insurance, which is 1.75% of my loan amount. So those are expenses that get added into an FHA loan. With FHA, you do not have that same cancellation option. So when I'm ready to move out of FHA and refinance at some point, I can do so. I'd want to refinance over to more of a conventional product. I look at FHA as kind of the entry point to homeownership if maybe I can't qualify in a conventional product, which would allow us to still get access to homeownership. But as maybe I improve my credit score, maybe I have more equity position in my house, then I'm probably going to look at refinancing into more of a conventional loan. So if we look at FHA, the expense structure is going to be a little bit different. We have the upfront mortgage insurance of $78.75. We have the monthly mortgage insurance of $206 in that same $450,000 example. So clearly a little bit more expensive, but FHA is going to have a lot more flexibility in the qualifying guidelines. Now, if you're doing searches on rates online, more often than not, FHA rates are going to show lower than conventional rates, probably 0.5% lower. But what you don't see behind the curtain, so to speak, is the cost of mortgage insurance. So if I'm a 760 credit score and I'm eligible for conventional, that is probably going to be the best option for me because not only can I put a lesser amount down of 3%, but the cost of mortgage insurance is going to be far less expensive. Okay. All right. Before we jump into income, I just want to take a quick pause. I'm giving you a lot of concepts and I want to make sure that I'm not missing anything or any questions. Any questions from our class so far before we move on to income? Okay. All right. Okay, so one question came out, and we're actually going to touch on this in about 5 minutes, which is what is the maximum debt to income ratio? It's actually 50%. I'm going to kind of give you the calculation of debt to income ratio in just a few minutes, so we'll touch on that for sure. So let's just dive into income because we're not too far away from the debt to income ratio. So I wanted to share with our class, like, what are the typical documents you need to allow us to validate your income. So it's usually providing the last 2 years of W-2s, the last 30 to 60 days of pay stubs. So those are all the things that would go into what we would need from you to kind of, like I said, validate your income. Now, as we look at different employment scenarios, that's where I get a lot of questions. And I think, we try to dispel some of the myths, if you will, when it comes to eligibility for home financing. So we do have to verify 2 years of work history and or education. So if I graduated from UF, let's say in the fall, and I started my new job this year, even though I haven't been on my job 2 years, as long as I can piece together my educational background in that 2-year window, along with my new job, then I could be potentially eligible for home financing, okay? So I don't have to be on the job for 2 years to be able to meet the 2-year requirement. I just have to put together educational or work history background. In fact, in some cases, you can get eligible for financing with as simply as an offer letter to purchase a home. I can't tell you how many times we've had situations where maybe, we have a prospective job for one of our clients. They're going to move from, let's say, Atlanta to Austin, and they have a job waiting for them in Austin, but they want to purchase their home before they start their new job. So we can actually close escrow on a home with an unconditional offer letter. So if I'm looking to get in my house by the end of March, but I'm not starting my job till April 1st, I could still purchase my home with as little as an offer letter. Now, on a 2-year requirement, if you're self-employed, we do have to see 2 years of tax filings in order to validate self-employment income. So that's a little bit different. If I'm work for an employer, but my employer gives me variable compensation, like let's say a bonus or commissions, right? Those to be counted, those need to have, or I need to be with my employer for 2 years. Because what we do in lending, we average those commissions or bonuses over a span of 2 years. All right. Now, if I work for multiple employers, like I'm in the healthcare industry and I have multiple clinics that I service, but for different employers, then I have to show that I've been working for both employers for 2 years simultaneously in order to count that income. Okay. Now, if I have a full-time job, but I also drive for Uber or Lyft on the side, that would also be a kind of a situation in a 2-year requirement that I would have to show that I've been on both jobs simultaneously for 2 years. Okay. And then the last thing I want to touch on when it comes to income is if I have another resource of income, maybe my partner contributes to the household, but for whatever reason, my partner's not being a part of the financing, that's okay. We just can't count that income unless they plan to participate in the financing and qualify just like you as a borrower, okay? I had a question that popped in as I was kind of going through the different scenarios there, which is what is the minimum minimum income to qualify for a mortgage? Family of 3, no debt. So there really isn't a minimum income per se. It just has to do with really what expenses you're going to have with a certain level of purchase price, which would be like the principal and interest and the property taxes, the homeowner's insurance, all those things. So does your income support that? And so that's probably a good kind of segue into debt to income ratio. I know we had another question about that. So what debt to income ratio does is it looks at expenses versus income. And when we're looking at that, we're taking a look at your current expenses like credit card debt, auto financing, student loans, all that stuff, right? And then we're going to bundle it together with what your projected housing looks like, principal and interest of the mortgage, taxes, insurance, maybe PMI if I'm putting less than 20% down. Maybe I'm buying a condominium and I'm going to have HOA expenses. So all that stuff goes into the expense bucket. And then we compare that versus your income. So our question earlier is like, what's the maximum that can be? Well, 50% technically is the maximum that can go to, which basically would mean that, if I'm making $4,000 a month, I can't have those expenses be over $2,000, right? We provided a calculation of a example here on screen for you. So this person is, got a $2,500 housing expense, $500 in other expenses, which totals $3,000 expenses, and they're making $8,500 a month. So their debt to income ratio is 35.3%. I would say in all the clients I work with all across the country, the sweet spot, if you will, not necessarily the qualifying, but the sweet spot or comfort zone is probably about 33 to 36%. Okay. So, but the guidelines to our point earlier will allow you to go much higher. So one of our classmates had a follow-up question on the minimum income, which is $50,000 enough to qualify for a home mortgage? So their answer was that, looking at $300,000 as a purchase price. So I think that's fairly close to make that mark. For your question there, we just got to figure out how much you want to put down, what type of property you're looking at, where's the property located? Because if it's in Dallas, Texas versus, Gainesville, the taxes could look different, or if you're buying a condo versus a single family residence. So I think, let's definitely talk offline. Let's figure out like through a consultation, like what that could look like for you. Another question we got in, which is if I have an offer, a letter for a supplemental fellowship that is additional to my salary promised over 4 years, can that be included to my combined income? So unfortunately, to add that supplemental income in, I would have to show that you're doing your full-time job plus the supplemental income simultaneously for 2 years in order to count that income. So unfortunately, like right now, if you're just going to be starting it, they wouldn't let us count that income. Now, if you can show that you've worked a similar position in the previous 2 years, so you've been able to maintain 2 jobs simultaneously for 2 years, then we might be able to count that supplemental income. Hopefully that answers your question there. So that's kind of a look at what income looks like. Now, the last component to homeownership that I think is probably one of the more challenging things is just saving up for homeownership. Now, you learned a little bit more about the minimum down payments for products. Here's what resources we can pull from in order to get to the down payment and closing costs. We are going to talk about first-time buyer programs in just a few minutes, but when you think about what accounts can you use for homeownership, I always kind of like to share this with clients. Of course, you can use your checking and savings accounts. It's just if you have cash that's going into these accounts, they can't be used because we have to season assets for 60 days. So if you just dropped $10,000 in cash into your bank account yesterday and you want to validate that for a home purchase the next day, we couldn't do that. But if that asset seasons for 60 days, we get 2 consecutive statements cleared with that deposit, then we could potentially use that. So we have to source any deposits that come into a home purchase. Now, you can use 401ks, 403bs, brokerage accounts can be used. I always encourage clients, if you're going to start using some of your investment tools, talk to your investment advisor or your tax advisor, make sure that's a good move for you financially. And then gift funds can be also used. That's where a family member is helping contribute towards your home purchase. Now, with your own deposits, those have to be seasoned, but with gift funds, they do not need to be seasoned. So you could have your uncle that wants to help you out with $20,000 towards your home purchase. Those monies do not need to be seasoned. Your uncle can transfer those over right away. There's a kind of a process that we go through for that, but it's a relatively easy process. It includes a gift letter, and then we have to document the transfer. Now, as we think about savings for homeownership, it's a challenge, right? And many of us are maybe kind of preparing for homeownership, but just haven't quite built the resources to meet the down payment requirements and or closing costs requirements. We might be doing really great with our cash flow right now, but we're not quite there. So I always encourage clients, if they're struggling a little bit with down payment, to implement a really quick and easy savings plan. And it looks like this. So I have it kind of noted on screen, but I'll kind of walk you through it. Like if you're paying $1,500 in rent, and that might be low for certain markets, but if you're paying $1,500 a month in rent, but you can think you can afford $3,000 based upon your job that you're working on right now, what I would encourage you to do to start building savings up quickly and effectively over the next 12 months is start paying into your savings account like you're making that $3,000 mortgage today. So first of the month, I pay my landlord the $1,500. That additional $1,500 in surplus goes right to my savings account, really, on a monthly basis. And I'm creating that discipline of paying that additional $1,500 or making the $3,000 mortgage payment. But as you know, obviously we're building our savings account at the same time. So by the end of 6 months, I have $9,000 accrued. By the end of the year, I have $18,000. So that's a really that's a good amount that can help you get to home ownership, especially when we're talking about a minimum down payment of 3%. We've had several clients that have put in that really simple way of kind of savings, and it's proved to be really effective for them. Now, assistance programs can also help you close the gap from what you have in resources to where you need to get to in down payment. So I do want to talk a little bit about some of the assistance programs. I know we have our class is kind of spread out all over most of the southern states and East Coast in terms of your target. I think we do have some Midwest represented too. So I'm going to give you kind of a general look at assistance programs, but we're going to look specifically at Florida and some of the programs available there as well too. I do want to just double check. I did get a question in the chat. I want to make sure that I didn't miss that. So let me just kind of read this out to the group. So is it more important to have 2 years of employment history shown by W-2s than 60 days of recent pay stubs? It's not that one is more important than the other. It's just, W-2s can help us validate, the kind of what you've made year over year. And it really depends on what your income structure looks like. So if you do have some variable components, we might be able to kind of dig in and average the income a little bit easier with W-2s. The 60 days of pay stubs is just to show kind of what your current income looks like. Because I may have finished the year making in 2025 making $60,000, but I got a bump in cost of living, and now I'm making $65,000 in February. So the pay stubs will tell us what we're making today. The W-2s can show us what we've made in the past. Okay. Now, kind of going back to down payment assistance programs in Florida, there's a few different options available to you, like the Florida Assist program, up to $10,000 in assistance. The homeownership HLP program, $10,000, but it's forgivable after 15 years. There's the HFA Preferred and HFA Advantage program, 3%, 4%, and 5% options that have forgivable assistance programs. And then Florida Hometown Housing or Heroes in Housing program has special incentives for first responders, educators, childcare employees, active military or veterans. So there's a lot of great resources we can pull from Florida. or for buyers and looking to purchase in Florida. Now, there are income limits on these programs, but we'll go ahead and send along those income limits to you. But most programs across the country do have income limits that are from 80% of median income. Some states go as high as 150% of median income. But for the most part, it goes up to like 120% of median income in most parts of the country. First time buyer, and the question we had is, are these for residents only? So you don't have to be necessarily an active resident of a respective state to participate in a first time buyer program, but you do have to intend to purchase there as your primary residence. So for first time buyer programs, you're not going to be able to buy multiple unit properties. You're not going to be able to, buy it as a second home or an investment property. These are designed to create affordable home ownership. So it has to be a primary residence, and it generally has to be a one unit property, like a single family residence, condominium, maybe a townhouse. Okay. We also have a program within APM, not spotlighted here, but it's called our 1% program, which is a really cool option too, which if you contribute 1% of your own money, we'll basically match it with up to a 2% grant that would be up to $4,500, maximum loan amount of $375,000. But, if I'm going to buy a $300,000 condo in Gainesville and the down payment is 3%, so that's $9,000. So if I'm going to contribute 1% of my own money, that's $3,000. You would get a grant of up to another $4,500 that would almost close the gap for that entire $9,000 down payment. So you would only be short like $1,500. So really great tool. Again, that's called our 1% program. Last thing here is the Pathway DPA program. That does not have an income limit, but it's only available for FHA. In fact, one of our team members within the alumni community utilized the Pathway DPA program for purchasing Gainesville. Really great product. Provided them 3.5% of their purchase price to cover their minimum down payment for FHA. So that's a great tool that's at your disposal as well. Just a quick side note for that 1% program, you cannot make more than 80% of the median income in your respective market that you want to purchase in. Okay. All right. Well, we're kind of rounding to the finish line here of class, and I didn't want to, finish off class without walking you through the buying process. It's probably one of the areas I get the most questions on, which is like, where do I go from here, right? You've attended class, you spent almost an hour with us. Hopefully you've got a few takeaways. So where do we go from here? Well, I would encourage you to get connected with us for a free consultation. That's a free service that we provide to the attendees of our class, where we sit down on a virtual session for 30 minutes or so and build out a home buying plan for you. Okay. So that's a free service we provide. The outcome or output of that session is to be pre-approved. Now, you don't have to be in a position where you're trying to buy a house this weekend, maybe not even this year, but we're going to try to provide some framework and a roadmap to home ownership. You and I will sit down and put some goals and objectives together in home ownership. We will get to a point where we'll have a pre-approval. The pre-approval is good for 60 days, but we can always recertify that at any time. So that gives you kind of a baseline of eligibility. Now, when you're ready, then you can move to step 2, which is house hunting. That's when you're going to start going out and looking at homes in the respective market that you're going to consider. So that might happen this year. It might not be for a few years, but at least you kind of know what your basic eligibility looks like. Now, as you begin the house hunt, it's probably going to start online, and then you'll eventually transition to in-person. I always encourage clients, get connected with a local realtor. We have a preferred network of realtors that we trust in the process that really create a great experience that matches what we do for our clients. So if you want a connection point, we're more than happy to deliver that to you. So let's fast forward a little bit. Let's say we're out looking at homes. We spotlight a few homes that we like. We spent 4 hours in the car on a Saturday with our realtor, and we find the one, right? We found the home that we love. Well, then that realtor is going to help kind of build our offer for us, and then submit that to the selling agent for the seller to consider our offer. Now, you may not get your offer accepted the first time around. I hope it does, right? But it may not happen. But in the event it does, and the offer gets accepted, then you're going to move to step 3, and that's called entering escrow. That means you and the seller have come to agreement on a purchase price and terms and conditions of your contract, and now we open enter escrow. When we do that, that same day, you're going to get a call from me saying, hey, congratulations, you did it. You got your offer accepted. Let's talk a little bit about now what you should expect as our client. So what we'll do is we'll meet with you for a follow-up video session, make sure all your financing is dialed in, explain to you the disclosure process, just make sure we have all of the details built out properly for your financing. We're also going to talk about interest rate lock strategy, like we highlighted earlier tonight, which is like we're going to try to time the market as best as possible to secure the best available interest rate for you. Now, you're going to have some action items on your side as a buyer, like making an earnest money deposit for your home purchase, which is usually 1% to 2% of your purchase price. Those funds will count towards your total out-of-pocket expense. So when we think about saving for down payment and closing costs, if I bought a $300,000 condo and I'm putting a 1% down payment, that $3,000 will count towards my out-of-pocket expense. Now, in most parts of the country, inside the real estate contract, there's a thing called a contingency. That contingency gives you protections as a buyer that you can do your research on the property just to make sure this is still a good fit for you. We'll make sure we get an appraisal done to make sure the value supports the purchase price. You'll have inspections that your realtor will organize for you. And of course, we'll get your loan approved. In most parts of the country, that contingency period is anywhere between 10 to 21 days, okay? Now, the total escrow process to go from accepted offer to getting the keys and starting the moving trucks up, it takes about 30 days in most parts of the country. It can be as short as 14 days, though. I would say our average closing time is probably about 21 to 28 days in most parts of the country. As we move through these milestones, you can see step 4 is processing and underwriting. That's kind of more the administrative functions of the process, verifying employment, verifying your assets, making sure your program is set up properly. Again, we're still kind of watching interest rates, what's happening. We're delivering disclosures to you that are all e-signature disclosures. As we move through the milestones, we'll get your loan approved as part of the contingency period. We'll make sure the appraisal comes back. And as we wrap up your loan approval, you're going to get some requests from our team of any maybe items we need to kind of finalize the approval. The disclosures will then, you'll be getting disclosures, I should say, during the process. There's initial disclosures within 72 hours of your consultation with us. There's another disclosure that comes when your interest rate is locked. And finally, 3 days prior to closing, we issue a final closing disclosure, essentially to give you a cooling off period before we get to the finish line. Now, step 6 is the finish line. That's the closing of the loan. In most parts of the country, the closing happens on the date of signing as well as the funding of a loan. That's called table funding. So for example, in Florida, if you were closing escrow on your Gainesville condo, you would sign your documents the same day. We would also close escrow the same day. If you're buying in California, you would sign today, then you would close tomorrow. Okay, so it's a little bit different in different parts of the state. But ultimately, on step 6, you're going to be signing documents with a public notary. You'll wire in your final funds, and then documents get recorded with the local county recorder's office to essentially transfer ownership and then basically apply the loan to the property. Once we get notified of that, then it makes it official. Now you're officially the owner of the property. And then, of course, we're going to give you that virtual high five and say, congratulations, you did it. Super excited. Actually, just before class, I called one of our clients in California to congratulate them. So really super cool, event. And it's really a big milestone or accomplishment in your finances, right? It has started so many times for our clients in a classroom setting like this, and eventually goes in and translates to the real buying process. Our relationship with our clients does not end at the closing of their home loan, because we're always staying connected with them, whether it's providing financial updates on the market, taking a look at refinance opportunities, or maybe exploring some of our tools like our HomeBot system to help you understand how to best manage your mortgage and your home equity in your house. So, we've had relationships with our clients for several years because we understand things change financially for our clients. Now, if you're thinking about moving forward in the process and working with me on building your own home buying plan, I'd love to connect with you again for a free consultation. We do it all virtually, so it makes it really easy and seamless for you. Doesn't make a difference what time zone you're in, but the 30-minute session allows us to dive in and really understand more about your finances and help kind of equip you with a strategy for home ownership. It starts with an online application. We only do a soft credit check. You'll then be requested to upload some documents and use our really simple scheduling system to schedule a consultation that's convenient for you. Okay, so it's a really easy process. And then if you have some questions after tonight's class and maybe you didn't want to ask them in a classroom setting, or maybe a scenario you want to run by me, I would encourage you to just schedule an introductory call with us, and we can hop on a call for 10 to 15 minutes or whatever time you need to get the answers that you need to really explore home ownership. Here's what a consultation looks like for you. It's very similar to what all the discussion points that we had into tonight's class. And as we kind of get towards the end of class, I just want to point out one of our technology tools. We embrace technology, whether that's mobile tools like our APM mobile, whether that's leveraging AI through some of our different calculators that we have. or our HomeBot system. But it doesn't change the human element in home financing. We can find out a lot through ChatGPT and whatnot, but really the expertise and the kind of the human touch of making a major purchase like this is really important. And so we want to be connected with you throughout this process. And that's I think one of our big value added components of working with our team in your home buying experience. In addition to that, we do provide discounts to you as part of our alumni community. So we discount our services. We're always trying to get the best priced option for our clients, access to first-time homebuyer programs, and of course our workshop series that's available all throughout the year. So we'll teach 3 other classes. So if you have friends or family that would be interested in a class like this, of course they can check out the recorded version, but we'll also have some live classes throughout the year. And we do have other partnerships across the country that can help support maybe friends, family, and coworkers that want to tune into some of our classes. You can find all of our upcoming classes at mortgageeducate.com. And as I close out tonight's session, I did want to pass along my contact information to you so you can check that out and send me a message, whether that's text, email, give me a call if you do have some questions. I did have somebody ask in the chat, how do we get connected with you for a chat? So Ken just dropped the link in the chat. So if you just want to click on that, you just schedule one of those convenient appointments. We'll make it happen. And we encourage you to check out what our local communities say about us in our socials, whether that's, somebody's talking about us in our Reddit community, or whether it's, Google reviews, or just some of the testimonials we're posting up on our Instagram. Looks like our Instagram logo is not here, but certainly, you can follow us at JMeda Mortgage. We try to put a lot of good resources out there. And of course, share with you what kind of our community says about us. We understand, really we're a major partner for you in this journey. We want to make sure that we provide you, like I said, all the tools and resources to be able to make homeownership a success for you. So with that said, I got 3 minutes left in class, but I'll stick around for any questions you guys have. You guys have been an awesome class tonight. Hopefully you got a few good takeaways for yourself. So feel free to drop any questions in the chat or Q&A. I'll watch those and answer any questions that you do have. I think I hit most of the questions that came in the chat. I want to make sure I didn't miss anything. Okay. Okay. All right. Any questions from our group? Okay, you're welcome. Thank you. And I do appreciate you guys attending tonight. Again, hopefully you got a couple good takeaways from tonight. This is a great way, again, to add that entry point to homeownership. I did get a question that came in a student scholarship of $35,000. Can I? Oh, I'm in a student scholarship of $35,000. Can I buy a house? I need to kind of understand more about what that means, and maybe we can talk offline. If you're gonna, I do have to show continuance of that $35,000. So I guess the answer would be maybe. Generally with income sources like that, we have to show that there's continuance of at least 3 years. So it depends on how long you're set up for that scholarship. Okay. Okay, good. Thank you. All right. All right. Well, unless we have other questions, I do appreciate you spending time with us on a Thursday evening. I know there's other things you could be doing, but we appreciate you spending some of your evening with us. We will get you out the recorded version of tonight's class. Of course, our slides, those will be up tomorrow. So thank you so much for being a part of tonight's class. Look forward to seeing you soon. Oh, I had a question really quick before I sign off. Question is, so if you are starting a new job and don't necessarily have the pay stubs yet, will you just need a signed offer letter? So yes, that's correct. So just the signed offer letter, you can upload that to your application profile whenever you decide to apply. And yeah, that we can do that. It's really easy. And then eventually when you get your pay stubs, you can upload those. So we'll have to talk through like when you decide to buy. Okay. All right. Any other questions? I want to make sure I don't sign off without getting it. Okay. All right, everyone. Have a great night. Enjoy the rest of your evening. I'll look forward to talking to you soon. Thank you so much for being a part of tonight's class with the University of Florida alumni. Have a good night.